I definitely had everything I needed and a little bit of what I wanted. We grew up middle class, but nobody in our family really talked about money. My first experience in learning about money, I went to school for accounting and finance in college, and I had the Dave Ramsey bug, like a lot of people do, and just learning to pay off high interest debt, and that really anybody can become a millionaire. If and Dave Ramsey's famous saying is like $150 a month in a mutual fund from 25 to 65. If all you do is that, you'll retire a millionaire. And having that accounting and finance background, and understanding the power of compound interest and just how that works, it it I was hooked. And that's all. When I was commuting to school 40 minutes each way, that's all I was doing, was listening to finance podcasts. And I wanted to become a CPA to do taxes and help people with finances. And I would attribute a lot of the success so far in helping other people with their money is I learned how to manage money before I even had money. Like I learned okay, if these, you hear these scenarios all the time, you have $1 million in your bank account tomorrow, what are you doing with it? Eh, I knew how to handle money before I even had money. And so it wasn't an issue. So I learned how to live on 40 grand a year when I was only making 60 grand a year. So that way now when I'm making 400 grand a year or more, I still know how to live on 40 grand a year.
And I don't think too many younger people are sitting there thinking like they're interested in getting into the tax world, or they're interested in helping people with their taxes. So what got you going down that path in the first place to, to want to go into finance and tax situations?
Yeah, I learned when I first learned about wealth building and how compound interest works. The next thing that you learn about is, well, how do you actually preserve that and keep that protected from lawyers, creditors, debtors, and the IRS? Because I had somebody say this one time, but the IRS is the silent partner that you have in every single deal that you do. Even if it's just you 100% own a property by yourself, the IRS is a silent partner. And if you don't know what to do that's legal inside the tax code, you're going to be working money over to Uncle Sam. And this is just even if you have one house or if you have 15 houses. I'll give you an example. I helped a client walk through this the other day. He makes over $500,000 a year in cash flow from rental properties, and he has a pretty high W-2 job to start off. So he's federal 37% tax brackets, California's 11%. So let's say he's paying 50% on all the income that he makes in rental properties. And he makes $500,000 a year in rental properties. But it's like, hey, if you don't do anything with your money, you're only going to have $250,000 left because you're going to send 50,000. You're going to send 50% to Uncle Sam. But more so, inflation's going to eat away at that other $250,000 that you have remaining. So it is in your best interest to, when you do receive a chunk of money, if it is not tax free, you need to redeploy that money into other deals or investments. So that way you can, number one, beat the tax man, but number two, beat inflation. Because as soon as that money hits your bank account, it's taxed and it's losing value to inflation, unless you're redeploying that. And that's why I tell people it's a game of Monopoly. People say real estate's a game of Monopoly, but it's also a game of hot potato too. If you hold on to the cash, you're going to get burned, right?
I like that analogy a lot. A game of hot potato. So not everyone in our audience is a real estate investor. I have a bunch of nuanced real estate questions as a real estate investor myself. But just for the general W-2 worker, maybe they have a side hustle, maybe they have a couple side hustles, but most of their income is coming from W-2. What are some just like easy, quick hit things that people can do to reduce their tax liability?
Yeah, if you're W-2, obviously there's traditional 401k accounts. So if you have an employer, so we normally recommend at least contribute to the employer match because that's going to be free. That's going to be free money essentially. HSA is a great account, a health savings account. If you're working at a decently sized company, they're going to have an HSA account. The HSA account is the only account that exists that's triple tax advantage, which means you get a deduction when you put the money in, and it earns and grows tax free. And then when you go to take the money out, it's also tax free as long as you use it for qualified medical expenses. So that's one of those accounts that I think is severely underutilized because there is no income limit with an HSA. Traditional IRA, Roth IRA, those have income limits. You can't make over a certain amount of money. With an HSA, you can make $100,000 a year or $1 million a year. It doesn't matter. You can still contribute to that account. So I would say 401ks, HSAs, and then just having that side hustle, like you mentioned. If let's say you sell stuff on Etsy or you use your laptop for generating income, As soon as you can have a side hustle or a business and you could start disguising some of your personal expenses as write-offs in your business, like the phone or the laptop that I'm recording this on, or the microphone, stuff that I would have used in my personal life anyways that I can now use in my business, I'm going to be able to deduct some of those as tax write-offs rather than just spending money and not getting savings from it.
And for things like that, or people who are running like a small business, I know I've heard before, like, okay, if it's so many years and the business hasn't made money, you can't just keep using this to, offset your taxes. And like, how does that go with your W 2? Like, so if you're making so much at your W 2, but the business that you've started is on paper losing money, can those two things offset each other? Just like some of the implications between maybe a business you're starting up that isn't really quite profitable yet and the rest of your tax situation.
Yeah, it all starts with the profit motive. So you have to go into business with a profit motive. If you go into business and you're trying to write off all these expenses, but you don't have any revenue to go against it, if you do that for too many consecutive years, they'll try to classify your business as a hobby, and they won't let you deduct the loss associated with that. So we see all the time people have side hustles or hobbies, or they might have even a rental property that they don't really take seriously for whatever reason. That could be classified as a hobby and they don't get to deduct their expenses. There was one interesting court case where like a family had a farm of horses for over 15 years, and every single horse that they bought, they were just deducting the horse against their W-2, and the IRS came in and disallowed all the losses for 15 years because they had never generated income from the horse farm. They didn't like sell the horses, they didn't race the horses, they didn't show that there was a profit motive there, so they ended up disallowing all their deductions.
I know one thing we talked about before we hit go here was kind of the hurdles to starting a business. I think a lot of people, they don't know what to charge. They're not sure like if they're valuable enough, if the thing that they want to create, the thing they want to sell is going to have an audience. Could you just talk to that for a second for those who are, they're sitting on the sideline, they're on the fence, but they haven't quite pulled the trigger because of some obstacle.
A lot of people think that you have to be a perfectionist or you have to know every single thing about a particular subject in order to help other people. But the fact is, you don't have to be an expert to start. You just have to be one or two steps ahead of the person that you're helping, right? So if you were once fat and you can now help people that are fat, or if you were once broke, now you can help people that are broke. That's why the first step of Alcoholics Anonymous is you have to find somebody that's already gone through the program, because that person's going to help you succeed. So a lot of people think they have to have it all figured out before they start. You just have to be one or two steps ahead of the person that you're trying to help. So the first time that I ever helped people with money was I helped people with Dave Ramsey's personal finance class at online and through church. So you don't have to be 10 steps ahead of somebody. You just have to be one or two steps above. And when it comes to value-based pricing, when it comes to setting your price, a lot of people will spend most of their life trading an hour of their time for a dollar amount. That's how 90% of the world sees their time, as what sort of job or task that I can do for an hourly amount. That's how people live their entire life. When you understand that it's not necessarily about how much your hour is worth, but what does the customer or the consumer get out of you putting the time into that product, that's when your life changes and you start doing what's called value-based pricing versus hourly-based pricing. So I remember when I started my accounting firm, like I remember charging $80 an hour was my hourly rate, and then $100, $150, $250, $300, all the way up to $500 an hour until I stopped doing hourly-based pricing, because I realized that I was the one that was losing out because my skills kept getting better and better and better. And if I'm able to save somebody $30,000 in taxes, what does it matter if it took me 1 hour to do it or 10 hours to do it? The client or the prospect doesn't need to know that. I'm still going to charge them the same amount, regardless of if it takes me 1 or 5 hours. And when you can really tap into what is that skill set that you have that is in demand and people will pay for it, you should never charge hourly. You should always charge based on the value that the customer or the prospect receives.
Yeah, I think that's a great tip. And like Cody said, a lot of people struggle with that when they're starting their own business, just putting a value to their own work and maybe being a little self-conscious about that. Jumping back into some of the kind of tax questions that we're peppering you with as we're recording this, it's almost the end of the year. What are some things that people can do to kind of close out the calendar year before the next year starts to to just maximize any kind of tax savings that they can.
Yeah, if they haven't already contributed to 401ks through employers, it's not too late. Go in there and adjust your percentage that you're contributing to your 401k to, again, at least get that match. If you're self-employed and you have a business, you actually have until you go to file your tax return to do any sort of what are called self-employed retirement accounts. So there's 401ks and IRAs and accounts that exist for self-employed people, not just people who are W-2s. And so you create those accounts before the year is over, but you have until all the way until you go to file your tax return to contribute to them. So I used to do it all the time as a strategy. At least create the account this year, so it kind of gets you in the door, and then you have all the way until you go to file your tax return to actually contribute to that. Maybe you don't have the cash right now to throw 10 or 15 grand at a retirement account, but you might in March or April, and it's going to help you save money on taxes too. So those are the things that you can do if you're just a W-2, if you're self-employed. If you're on the real estate side, I like to do what I call like a 3-month lookout. So I look at all my properties in my portfolio, and I try to figure out January, February, March of 2024, what are some of the things that I know that these properties need work done on, and what can I spend this year so I can get the tax deduction this year rather than next year. So things like supplies, linens, if I need K-cups for some of my short-term rentals, whatever I need, like let me spend it now so I get the tax deduction now. The only thing I would recommend against doing is don't pay any contractors up front for future work, because you might not ever see the money. But those are just some of the things that you can do, in your rental portfolio. More advanced clients are really hustling to buy properties and put them in service so that they can get depreciation to offset their other income. So let's say I sold a property in March of 2023 for a huge gain. And again, hot potato, right? If I hold on to that and I don't redeploy that capital, I'm stuck paying taxes on the gain. Well, one of the things you do is you just have to get another property in service before the end of the year. You can use the depreciation and losses that you generate on that new property to offset the gain of sale from your property in March. As long as they're both in the same calendar year, you're going to be able to use the loss for one property to offset the gain from another. So we have a ton of clients that are, right now as we speak, under contract on deals. We just closed on something last week. We have tons of people that are before year end trying to buy property.
What do you mean when you say in service?
Good question. So the traditional version of in service, a lot of people take it to mean that you need to have a renter or a tenant, somebody come and stay. That's a good way to think about it, but the IRS's definition of in service just means it needs to be available for rent. So if you're talking about a long-term rental, that could be like you're permitted, everything's ready to go, you have running water, electricity's in there, and you stick a for rent sign out front. That's technically in service before the end of the year. For a short-term rental, you're going to have, it's going to be fully furnished. It's going to be listed on Airbnb. It's going to be permitted, but you don't need to have a Airbnb guest for it to be considered in service. It just has to be what's called available for rent at a fair market value, right? You can't list if your long-term rental comps are $1,500 a month, you can't list it for $5,000 a month and call it in service. It has to be in service at a reasonable rate, that a fair market value that somebody would be willing to pay.
And I've seen some of your posts, speaking of Airbnb, around like cost segregation. And I'm curious, for someone who maybe is Airbnb out their primary home, I've read some things from other people about like cost segregation with your primary residence. Is there anything there you could talk about as far as maybe that's something people aren't realizing they can take some kind of tax advantages from, a room, or if they're renting out the whole house sometimes for their primary residence?
Yeah. So number one, it goes back to the disguising some of your expenses as business deductions. So let's say you have a duplex and you run out one side and you stay in the one side. Well, traditionally, mortgage interest, taxes, insurance, those are only deductible if you itemize your tax deductions. But the minute you have a renter in the other side, well, that half of your insurance, half of your property taxes, your mortgage interest is now being attributable to having a rental. So you're going to be able to deduct those as expenses, but otherwise you didn't what's called itemize your deductions, so you weren't able to get those write-offs. Again, your phone and data and your internet, all the maybe you do repairs on that side of the duplex that you wouldn't have done if you were just living in it. So those are going to be deductible. But then to take it a step further, now that you have a rental property, right, the other half of your duplex, you can do things like cost segregation, accelerate depreciation, use whatever loss that you generate from that to help offset your W-2 income. Because if I'm a high W-2 earner, if I make over $100,000 a year as a W-2, I'm not able to take any losses from long-term rental properties or multifamily properties against my W-2 income. But if I make over $100,000 a year and I'm doing short-term rentals, like average of 7-day or less stays, I can use that loss to offset my W-2 income. So we have tons of nurses, doctors, lawyers, people in tech. I have other CPAs that are clients that are high income earners that are using short-term rentals, whether it's not their primary residence or it is part of their primary residence, to offset their high earning income. Because like I said earlier, otherwise there's limited things that you can do to offset your income if you're just a W-2. Yeah, 401ks, HSAs, and you can have more babies. That's about it. That's all you can do if you are just W-2 alone. But once you are in business or you have rental properties, that's where the tax code gets exciting because when you look at it, Congress writes the tax code, the IRS just enforces it. And Congress they get paid like $200,000 a year to be in Congress, but they're all worth $30-40 million. They got that money from somewhere, and that's because they're business owners, they own real estate, or their dad or mom own real estate or business owners. That's how they all got their money, right? But what are the laws that they write? The laws they write are favoring people who own businesses and who own real estate. So it's no wonder that the tax code incentivizes that certain behavior, and you just have to learn how to follow it.
All right, I'm getting excited because these are the types of questions that I was dying to ask you. I've been scouring your content for the better part of today, getting ready for this interview. I want to hop back real quick just before we kind of dive into real estate stuff on the disguising your personal expenses as business expenses, because I know sometimes this can go wrong. The person, decides they want to become a realtor, and then they buy a $60,000 BMW and a whole new wardrobe, and then why not right off that vacation to Hawaii for $10,000 because they talked about becoming a realtor there. And all of a sudden, they have like these $70,000 of quote unquote business expenses. Where I'm getting at here is where can this go wrong? Like, where do you draw the line? How do you determine what's a legitimate business expense? Or what are some red flags people should watch out for so they don't get audited and screwed by the IRS?
Yeah. So in order for it to be an actual business expense, number one, you first have to be in business. So let's say you're like, hey, I want to go to Hawaii. I'm going to go to Hawaii on vacation, but I'm gonna go look at a property or two because I want to be able to deduct that vacation or that flight to Hawaii. Well, you're not able to write off the cost to Hawaii unless you're deemed to be in business. So if I just go to Hawaii and I just look at properties and I don't actually close on anything, I'm not able to deduct those expenses because I'm not in business yet, right? So just flying to a state and having expenses but not being in business doesn't make it a write-off. That's the thing that people get wrong all the time. So like I live in Illinois, I have property in Colorado, Texas, Florida, Missouri, Maryland, Ohio. And then let's say I want to go to California, but I don't have anything in California. So my trip, my costs, my expenses to go to California to look at rental properties are not deductible unless I actually close on something in California because I'm not in business yet. Furthermore, the expenses that you have to be what are called ordinary and necessary in a course of business. So the easiest way I explain this is like, let's say I'm a doctor and I have an office that's 5 miles from my house. Is it ordinary for me to use a car to drive there and back? Yes. Is it necessary for me to use like a Porsche GT3 or, not Porsche make the GT3? I can't remember, but is it necessary for me to get a $180,000 car to drive back and forth to the office? That's the part of the tax code that, hundreds of people have found themselves in hot water because they've taken that necessary to mean a whole lot different than what your average person takes it to be. So that's what we always tell people too. And I would say before that, it's always never let the tax tail wag the dog is what I say. So what are you actually saving? Or if I'm in a 30% tax bracket and I buy a $100,000 car, sure, I can write off the $100,000 car, but I'm still out $70,000 out of my own pocket because now I have this huge loan or this liability that's just sitting in my driveway or my garage. So I hope that it kind of explains. It has to be ordinary. It has to be necessary in the course of one's business. And first you have to be deemed in business in order to take the expense.
Now, as we talk through, a lot of these strategies, some of them are a little bit more advanced. I think realistically, a large majority of people are just using kind of free online, free online tax preparation software. Are these things something that's going to pop up? Like when you go to, your free tax software, is there going to be something that pops up and say, hey, do you have a short-term rental? Or like, how can people make sure that they are, checking the boxes for the things? Because you don't know what you don't know. So they may not know that, like, hey, this is something I could deduct.
Yeah, and that's the problem with it. If you're just a W-2 or maybe you have a small side hustle, you probably can get away with using like a TurboTax or an H&R Block online. But as soon as you have rental properties or your side hustle hits, let's just say 30,000 or more in income, you should have somebody that knows what they're doing prepare your tax return, because like you mentioned, when you are a small business owner, you go on TurboTax to file your tax return. The first thing you don't know is like, am I an entity in the eyes of the IRS, or am I just a sole proprietor? A lot of business owners don't know that the answer to that question. And if you just go in there and you click the questions that they ask, you may not know that you're clicking the right or wrong button, and then you just go down this rabbit hole where I'll say this: I've seen hundreds of returns I've seen prepared by people that either have self-employed small businesses or rental properties. I've only seen one person that's ever done it right, and that person had an accounting degree. So nobody's ever gotten there. Like if Cody bought a rental property tomorrow and he prepared his tax return, I've never seen anybody ever get all their expenses that they needed to deducting, closing costs, repairs, the depreciation right. I've never seen anybody do it except one guy, and he had an accounting degree. So if that tells you anything, if you ascend to a level where you're not a W-2 anymore, but you have a profitable small business or you have rental properties, you should have an accountant prepare your return. Now, do you need to hire an actual tax advisor like myself or somebody else to help you with tax strategy throughout the year? Maybe not, but you should at least have somebody prepare your return so that way it's done the right way.
I think this might be a fun question, and you can answer in any order that you'd like. What is one underrated tax strategy that not enough people are using and people aren't talking about? And then what is one overrated tax strategy or wealth building strategy that so many people are hopping on the bandwagon, but you're like, guys, it really doesn't make a difference?
Yeah, I would say the most overrated, overhyped tax strategy is by far the like Augusta rule, the home office or rent your primary residence out for 14 days, because realistically, nobody's getting $500 a night or more for their primary residence. Like I live in the suburbs of Chicago. Like somebody, I would actually probably have to pay somebody to come stay at my house for a night. Like that, it's just people on social media take that one way too far. It does have its motive, and it was the reason why it exists is because of you guys know the Masters golf tournament. So people that own homes in Augusta used to rent them out for the tournament, and they would collect like $30,000 in a week to rent out their home. And then the IRS obviously wanted their share of the pie, and that's where they came up with, well, hey, if you just rent out your primary residence for less than 14 days, we're not going to tax you on it because you don't really have a business here. You're just you're only renting it out when you need to. So I actually had a buddy who owns a couple apartments in Nashville. And when Taylor Swift came to town, he was renting this thing out for like $1,200 a night, 3 nights, $1,200 a night when Taylor Swift was in town. And, he got to claim it tax free. But for 99% of people in the world, they're not going to be able to use that strategy. So it gets overhyped. What a lot of people don't talk about that's really powerful is a taxable brokerage account. So it's not necessarily a tax strategy, but it's a different type of account that people are not used to. Everybody's familiar with 401ks or IRAs, but not a lot of people talk about the taxable brokerage account, because the taxable brokerage, you pay taxes when you put the money into the account. So it's just like a Vanguard or TD Ameritrade, Charles Schwab. You pay taxes when you put the money into the account, but that money earns and grows at capital gains tax rates. So when you go to withdraw that money, you're only paying 0, 15, or 20% based on whatever your bracket is. Most people pay 15% on capital gains. But if I'm a high W-2 earner, let's say I'm in a 32% tax bracket, and that's what I pay on my W-2, if I make 50 grand on my W-2, I got to pay 32% in taxes. But if I make 50 grand in my taxable brokerage account, I only have to pay 15% on that money. And the taxable brokerage account really is that bridge between where you are now and retirement age financial freedom. Because people who are saving for retirement through 401ks, IRAs, they cannot access that money until they're 59 and a half. Like what if I hit big and I have a lot of wealth and I'm 40 years old and I want to retire early? Realistically, the only way you're able to do that super tax efficiently is using the taxable brokerage account, which allows you to withdraw money at any point in time you want and pay capital gains rates. You could borrow against that taxable brokerage account or rental real estate. Taxable brokerage account or rental real estate are the only ways you're going to be able to retire early in a tax efficient and inflation resistant example. Like, sure, I can get $3 million deposited in my bank account and probably retire tomorrow, but what's going to happen? It's going to get eaten away by inflation. I'm going to have to take that $3 million and I'm going to have to put it in a taxable brokerage, or I'm going to have to put it in real estate and let it keep working itself. So overhyped is the Augusta loophole, and then underhyped is taxable brokerage account for me.
And since we do have a lot of people who are chasing financial independence, and you've mentioned kind of like those high income earner W-2s, which I think we've got a lot of listeners in that bucket. For people who know, like, hey, this is my last year as a high W-2 and high paying W-2 employee, and next year that's kind of falling off a cliff. I'm not taking that W-2 anymore. My income is going to drastically reduce. Are there any kind of things to keep in mind as you go in from the transition of this year to the next year? Any things to do before this year ends, or any things to, make sure you take advantage of when that new year starts and your income isn't there?
100%. Yeah. So the first thing that I look at is when I work with clients, it's always looking at what their tax bracket is now versus next year versus where we think it's going to be maybe 5 years down the road. Because if I'm in a high tax bracket now and I project myself to be in a lower tax bracket next year, the first thing my mind goes to is, what am I doing with retirement accounts? Because if I'm in let's say a 32% bracket one year and I go down to a 22% bracket the next year, I'm going to maximize my traditional 401k and IRAs when I'm in a 32% tax bracket, because that's what I get a tax deduction at. But then I'm going to look to do Roth conversions in years where my income is lower, because now when I was paying 32% on my Roth retirement, now I'm only paying 22% or lower because I don't have as much income. So anytime clients or people have what I call a shock in income, where you're used to making a certain amount, and for whatever reason, somebody loses a W-2 or somebody loses a job, somebody gets a job and makes a lot more money. Maybe you get married, all these different things, or you buy enough rentals so you have a lot of losses, all these things that create a shock in income. You want to first think about what do I do from a tax perspective? Because if my income is going to be a lot lower in the next year, I want to do traditional now and I want to convert to Roth in the future when I'm in a lower bracket. But that's just from a tax perspective. The other thing you have to look out for when you're chasing financial freedom is, what does that do from a lending perspective? Because I've seen a ton of people, and traditionally, generally speaking, you're normally going to be able to borrow about 5x whatever your W-2 salary is in the form of loan amounts. So if I make $100,000 a year, there's going to be a bank out there that'll give me up to $500,000 in loans based on my W-2. I normally use this like 5x rule, right? Well, if my W-2 goes down to zero or goes down to 50 grand, now I'm really only going to be able to buy $250,000 worth of real estate. So I've seen people mess themselves up from a debt to income perspective because they're a high W-2 earner. They buy a bunch of rental properties, they max out their DTI, and then they lose their W-2. They cut off all borrowing potential or power because now they don't have that income. So not learning how to make that transition between, okay, like, are my tax returns filed correctly so I can actually use that rental income and count that against my debt and have that work for me, not against me? And then, am I prepared to go the non-conventional Fannie Freddie route? Like, am I prepared to go the DSCR route, bank statement loan route, commercial route, raising money from other partners route? And a lot of people are not able to put all that together. And that's kind of really what I help people understand is, you have tax issues, you have loan issues, you have cash flow issues. Anytime you go from high income down to low income, or vice versa, low income to high income.
Could you maybe just quickly define those two terms and why that first one or why the former is so important?
Yeah. So tax prep is the actual preparation of your tax return in April 15th. So April 15th, 2024, we're all going to be rushing to file our 2023 tax return. The problem is if you're just thinking about taxes then, you're way too late because the year's already over. There's nothing you can do once the year is over to help your situation. Like there's maybe one or two things that you can do. That's it. Tax planning is so much more important than the actual tax prep because tax planning allows us to sit right here, right now and say, what is our tax liability looking like for this year based on what we've already made before? And what are some of the things we can do before the year is over to actually help us save money on taxes? So it's tax planning or consulting, let's call it, that's way more important than tax prep because tax prep is just putting your documents together and saying, oh, here's your tax liability. And then your accountant says, oh, well, if you did this, and that, you could have saved money. You want somebody that's actually there with you telling you what to do. And that's, you might have heard the term like Monday morning quarterback. If you're tax planning, if you're consulting, you're the offensive coordinator. Like you're getting shots called, you're getting things done the right way. If you're just going to somebody to do your tax prep, that's like Monday morning quarterbacking. All they're going to tell you is like, oh, you should have done this or you could have done this. So tax planning, way more important than tax prep.
So tying like planning, prepping, and real estate all together, let's say, we're here, the year's not over yet. You've just bought your first investment property. What are some of the things that you can do from a planning perspective? And what are some of the maybe documentation and things that you need to make sure that you have so that you can properly do the preparation when the tax filing comes?
Yeah, the first, it always starts with your profit and loss or your books. So do you have your books in order? Do you have all your rental income accounted for? Do you have all your renovations accounted for? And are you tracking those on a month-to-month basis? Because where people really lose out is they don't even know where they're at to begin with. So if you come to me and you're like, hey, I really want some tax strategy. I need help. I made a lot of money this year. But if I don't know how much money you've made this year, I can't help you. It's like you go to a doctor. The doctor is like, let's say your knee hurts, right? And is the doctor going to give you a pill and numb the pain, or are they actually going to figure out why your knee's wrong? Like, what's wrong with your knee? Why is it hurting in the first place? Type of thing. So if I don't actually know what your income is because you have really sloppy books or bad record keeping, then I don't even know what strategies to help you implement.
Sorry, there was something in the background. What was I going to say? Oh, yeah. So not all real estate is created equal. And I want to ask you, Ryan, how different types of real estate are treated in terms of tax. So obviously you could go out, you could buy a rental property. There's also syndications you can invest in. There's REITs you can invest in. When it comes to tax strategy and reducing your tax liability, like which ones are good ones, which ones maybe don't help so much?
I would say first off, all income is passive income when it comes to real estate, right? So you make $100,000 in real estate, no matter if it's long-term rental, short-term rental, commercial, syndications, it's still a lot better than making that same $100,000 at your W-2 because you're paying less money in taxes, right? But I said earlier, long-term rentals or multifamily, you can only take those losses against your W-2 if you're considered a real estate, right? Short-term rentals is the only type of real estate where you can actually take the losses from that against your W-2 if you're not a real estate professional. So again, tech workers, salespeople, lawyers are buying short-term rentals and using them to offset their W-2 when you cannot do that with long-term rentals, multifamily, syndication, etc.
And so I totally understand that you're not going to be able to offset your passive losses unless you have the real estate pro designation. Is that different for REITs? I know that was one of the categories I mentioned, but because like a REIT isn't a direct ownership like a syndication, right? It's something different.
Yeah, a REIT is still going to go inside of that passive bucket. So you could use REIT losses to offset REIT gains, but you're not going to be able to use the REITs to offset your W-2 income.
Okay. And REITs also don't have the bonus depreciation and cost seg that like a regular rental property or a syndication might have, which you can get those mega tax savings from.
Yeah, I mean, for people that are, I would say that's actually a good point. So REITs are really good for people that, in my opinion, have already built some wealth and are looking to diversify away from like the equity markets or their 401k and get it into REITs like more passively. if you're trying to build wealth, the best way to do that is for you to build sweat equity and actually build wealth through properties and getting all the tax benefits for yourself. But what it really comes down to is what I call like a time on equity audit. So you're looking at your portfolio and you're saying, well, this property is making me $500 a month and this property is making me $1,500 a month, but they're both taking the same amount of time. What is an hour of my time worth? A lot of people don't realize that right away. Also, a lot of people, their highest ROI skill is not what they're most passionate about either. So I deal with a lot of doctors, dentists, lawyers who like their highest ROI skill is obviously doing that trade or business, but they're not most passionate about that. They're most passionate about like being with their family or rental properties. And so if your highest ROI skill is not also what you're most passionate about, that high ROI skill is just a means to an end until you can find what is you're most passionate about doing. And then your work doesn't feel like work because you're passionate about
it. I know I've asked a couple questions about the, like cost segregation and like an Airbnb where your primary residence, partly selfishly because we do Airbnb at our house. But we have only talked about cost segregation like with, one other guest. So it's kind of an interesting topic for me. And I'm curious, is there like a proration thing when you start to mix this where it's like, okay, now it's your primary house, but say you're renting it a couple days a month. Is it like, okay, now you only get 2 over 30, 2 days out of the 30 kind of benefit of the tax deduction, or just simply by renting it out once, now all of a sudden you can do this and you're getting the same benefit as somebody who's rented it out 50% of the days?
Yeah. So let's say you have a traditional rental or a duplex. You live at one unit, you rent out the other unit pretty much full time. That's going to be prorated 50%, because not your entire house is being a rental, only half of it. So you're going to get like 50% of the benefit that you would have gotten if it was a full rental. What you're talking about is the personal use days rule. So if you have a rental property, whether it's attached to your primary or not, there's a certain amount of time that you're able to use that property for personal use and still get tax deductions. Because as soon as you use that property for your own personal use too much, the IRS limits the amount of deductions that you're able to take because they're saying you're not really operating as a business anymore. It's more used for personal use. And so just so you know, like that rule is 14 days or 10% of the total rental days that you have. So everybody gets their 14 days personal use if it's a rental property, regardless. But let's say I had 170 days a year where I rented that property out, then I get 17 days personal use because it's 10% of the fair market. So I get 14 no matter what, but I could get 17 or 20 or 25 depending on how much I rented the property out, and still get the same tax deduction. Yeah.
Okay, cool. That is a cool rule. And I guess I'll selfishly ask questions as well. So one thing that I'm doing, I'm hoping you can better explain this to the audience, is my wife is getting the real estate pro designation for managing our rental properties and Airbnbs. And then I am actively investing in syndications and then offsetting those, what would be passive losses, against my active income since they have that real estate pro designation. Could you just quickly explain how the real estate pro designation is defined in the eyes of the IRS and like what parameters you have to check to get it and to use some of these really awesome tax strategies that we're talking about?
Yeah. So for a real estate professional, you have to prove that real estate is much of all that you do. So it's 750 hours in what's called a real property trader business. So a lot of people get that by being a real estate agent or a broker or a property manager or somebody in real estate construction. Like they might get 750 hours there. If you manage a portfolio of properties, you'll obviously get it through that. So you need 750 hours in real estate, but more so, you also need the 750 hours also has to be more than half your working time total. So if you're a doctor or a CPA or a lawyer and you work 2,000 hours at that job, you would have to spend 2,001 hours in real estate. And that's why a lot of, hiring professionals that are not in real estate don't qualify as a real estate professional, because they would have to spend more time in real estate than they do at their job. So that's why a common strategy for married couples is one spouse is a high earner in a non-real estate field. The other spouse is working full-time in real estate, either on their rental properties or maybe they're a real estate agent. And now you are able to use those losses to offset the other spouse's high earning income. It's a very common strategy that we recommend doing. But the syndication part that you're talking about, I would say that I only have maybe 5 clients a year that use that strategy. It's where, because like I said before, normally you're not able to take syndication losses against your W-2 income. If you're a real estate professional, it allows you to group in the syndication losses with your rental losses and then use all of the losses against your other spouse's higher income. So like I said, I probably have maybe half a dozen people that use that year to year, just because not a lot of people know it, but then also there's not a lot of people that qualify for it either.
And just digging into this rule a little bit more, let's say I'm someone who has just retired, doing the early retirement thing next year, don't have the W-2, so I don't have any hours to kind of log there. And all I've got are maybe my 1 or 2 rental units that I have. Do I just log my own hours? And as long as I hit 750, I can consider myself a real estate professional?
So you would try to get 750 hours between your 2 properties, which would be a little bit hard because it's only 2. But think back to what you just said. If you're retired, quote unquote, you probably don't have a high income that you're trying to offset in the first place. Real estate professional status is useless unless you have a super high tax bracket or income that you're trying to offset. Because if you're retired and all your income coming in is real estate, well, odds are you're in a super low tax bracket anyway, so you don't really need to. You're not offsetting anything. Now, if you were quote unquote retired from your W-2 and you were trying to do a bunch of Roth conversions from your traditional accounts, and those Roth conversions stack on top of your bracket, then you would want to be a real estate professional in order to offset those Roth conversions. But this is what happens with a lot of clients, especially the ones that are using the taxable brokerage account and just investing in real estate, is by the time they go to retire, they're not even in a tax bracket. Like they're literally in a 0 or 10% tax bracket because of how all their income is. It's either rental income or that capital gain portfolio income.
Is there anything when a new client comes to you and you start looking over their tax returns, like, is there one glaring mistake that most people are making or the average CPA is making on some of your clients' tax returns? Like, what's something that people are just overlooking and time again you see, oh, here's another one, it's wrong again?
Yeah, I would say the biggest thing would be the way that their rental properties are reported. So, for example, you could have a single family home, like let's say I have a 5-bedroom house. If it's used as a long-term rental, it needs to be marked in the tax software as a long-term rental. And if it's used as a short-term rental, it needs to specifically be marked as a short-term rental in the tax software. And if you don't do that the right way, you could potentially open yourself up to an audit because, for example, like most long-term rentals, the owners are not paying for utilities. In short-term rentals, you're always paying for the utilities. In short-term rentals, you're going to have like cleaning fees, right? But they're not going to show up as a long-term rental. So the way that your properties get reported is really important. And I always see like prior CPAs or accountants make those mistakes. But then also the way that they're depreciated. So long-term rentals or single-family homes are depreciated over 27 and a half years, where short-term rentals are depreciated over 39 years because they're considered commercial transient use. And so even that depreciation, 99% of people get that wrong also. So that would be a reporting problem that I see a lot. I also have a lot of clients that they give money to charity for various reasons, but they're not doing it tax efficiently. So I talked about earlier about the taxable brokerage account. What you're actually able to do is you're able to donate appreciated stock from your taxable brokerage account to a charity or a church of your choice, and you get the same tax deduction as if you were to give them cash. But now you get to reduce the overall capital gains that you pay on that brokerage account. And the best part is you take that same money that you would have spent in cash to the church, and you use it to replenish your brokerage account. And then eventually your fair market value of your brokerage equals your cost basis. And then you're able to sell the brokerage account completely tax-free. So that's something where I see it a lot. I mean, probably every third return I see, there's people that have a taxable brokerage account, are contributing to charity, but are not meshing the two and donating to charity from their brokerage account. But it's a strategy that could easily save you like $4,000 or $5,000 a year for the rest of your life.
Well, that's a great tip, especially as we come into the holidays. It's a win-win where people can lower their, tax burden, but also help someone out with a little charity. Ryan, I just wanted to say, appreciate you giving us some time today to come in and speak. I know taxes are always one of those, probably the more complicated parts of this journey, and one of the things that maybe scares people the most, and are maybe the most misunderstood. So we appreciate you giving your time. For those who want to, for those who want to follow along with you, get more resources from you, get more knowledge from you, where are some of the best places people can follow along with you?
Yeah, I would say, taxes is just, we file taxes every year. We also probably play board games with family members once a year. And taxes are just like a board game. So like the first time you go to play it, you don't know the rules. So you have to play with somebody like a family member or a friend that's actually going to teach you how to play the board game. And that's why I created my account, was to help people, play that game. If you want to follow, it's just going to be on all social media platforms at Learn Like a CPA. So that'll be Twitter, TikTok, Instagram, Facebook. And then I also have a Facebook group called Tax Strategies for Real Estate Investors. We have over 8,400 real estate investors in that group, engaging daily. So those are the many places you can get in touch with me.
Sweet. Well, just want to echo what Justin said. I was kicking myself during that last little segment there where I'm like, you know what? I am contributing to a brokerage account and I am donating out of my bank account. So that is a $4,000 to $5,000 per year tax strategy that I could implement tomorrow. So thank you, Ryan. I'm gonna start doing that. And just want to appreciate you. Just want to say thank you for your time, and we appreciate you, man.